Hello and welcome. Today, we're going to tackle one of the biggest and, let's be honest, most confusing topics in finance, stocks. We're going to break it all down and figure out what it really means to own a piece of the pie. I bet you have. You're just scrolling and you see all this jargon, buying the dip, bull market, short squeeze. It can really feel like an exclusive club you're not a part of, but it's not. And by the end of this, you'll know exactly what's going on. All right, so first things first, what is a stock? Let's forget all the complicated charts and fast-moving numbers for just a minute, because at its heart, it's a really simple idea. It all starts with owning a tiny slice of a company.
That's literally it. A stock isn't just some abstract number on a screen. When you buy a stock, also called a share, you are buying real, actual ownership in a business. You become a part owner.
This is probably the best way to visualize it. Imagine a huge company, like Apple or Amazon, is a giant cake. Buying one share means you get one slice. If you buy more shares, you get more slices. Pretty simple, right? Okay, that's the logical next question, isn't it? I mean, if you baked an amazing cake, why would you start selling off slices to a bunch of strangers? Well, there's a really good reason for it. It all comes down to raising money, or capital as it's called. Instead of going to a bank for a loan and getting saddled with debt and interest payments, a company can sell off little pieces of itself. They get a big influx of cash that they can use to innovate, to build new factories, to expand, whatever they need to do to grow. Now, to make this crystal clear, let's walk through a little story. Let's follow an entrepreneur named Maya. She has a dream to open up her very own sneaker store called Fresh Kicks. So Maya does the math, and she figures out that to get her dream off the ground, to rent a space, buy inventory, all of it, she needs $100,000. That's a lot of money, and she needs a smart way to get it. So here's her plan. She decides to split her new company up into 10 equal shares. Think of it like that cake again, but this time with 10 pre-cut slices. She keeps 5 slices for herself, because hey, it's her company, and she decides to sell the other 5 to investors who believe in her idea. And this is where it all clicks into place. An investor named Jordan hears about Fresh Kicks, and he loves the idea. He buys one of those shares for $10,000. Just like that, he now owns 10% of the entire business, and Maya is $10,000 closer to her goal. It's a win-win. So, Jordan is officially a part owner. But what happens next? This is where we get to the real heart of investing, the chance to make a profit, but also the reality of taking a risk. Okay, let's jump forward a few years. Scenario 1. Fresh Kicks is a huge hit. The store that started out being worth $100,000 is now valued at $300,000. So Jordan's 10% stake, that little $10,000 share he bought, it's now worth $30,000. That's an amazing return. But investing isn't always a home run. So let's look at scenario 2. Maybe the store struggles with online competition. The business's value drops to $80,000. Now Jordan's 10% share is only worth $8,000. He's actually lost money. And this can happen for all sorts of reasons. A bad economy, a change in trends. This is the risk that every single investor takes on. So, in our story, Maya sold a share directly to Jordan. Pretty straightforward. But for huge public companies with millions of shares, where does all this action happen? Well, that's where we enter the massive global stock marketplace. It all happens on what's called a stock exchange. The name sounds kind of formal, but the concept is simple. It's just a giant organized marketplace. Think of it like eBay, but for tiny pieces of companies. And when a private company like Fresh Kicks gets big enough and decides it wants to sell shares to everybody, it has what's called an initial public offering, or an IPO, on one of these exchanges.
And you've definitely heard of the big ones. The New York Stock Exchange, the NYSE, and the NASDAQ are 2 of the most famous marketplaces on the planet. This is where millions of shares of thousands of companies are bought and sold every single day.
Now, here's something interesting. Just like when you go to a concert, you can buy a regular ticket or a VIP pass, not all stocks are the same. There are 2 main types, and the concert ticket analogy is actually perfect here. So, your regular ticket is called common stock. This is what most people buy. It gives you voting rights, so you get a say in big company decisions. You might get paid a share of the profits, called a dividend, but it's not a sure thing. This stock has the highest potential for growth, but it's also the riskiest. Then you have the VIP ticket, preferred stock. You usually don't get to vote, but you get a fixed, predictable dividend payment. And if the company gets into trouble, you get paid before any of the common stockholders. So the trade-off is this. Do you want a bigger potential reward or more stability? Okay, so we've talked a lot about risk. You might be wondering, why would anyone put their hard-earned money into stocks when they could just keep it safe in a bank account? And the answer really boils down to one powerful word: growth. Just look at this chart. Over the long haul, historically, a savings account might earn you, 1 or 2% a year? But the stock market, on average, has returned somewhere between 7 and 10%. That might not sound like a huge difference, but when you compound that over decades, it is absolutely life-changing. And that brings us to maybe the oldest, wisest piece of investing advice there is. Think back to Jordan. If he'd put every penny he had into Fresh Kicks and the store failed, he'd have lost everything. This idea means spreading your money across lots of different companies, lots of different baskets. So if one of them drops, you don't lose it all. So now you know a stock isn't just a number. It's ownership. It's a slice of the pie. And once you see it that way, it kind of changes how you look at the world, doesn't it? Every brand you use, every app on your phone, it's a potential piece of a company you could own. So I'll leave you with a question to think about. If you could own a piece of any company out there, what would it be?